These are the best stocks to buy now in the streaming services sector. There's been a lot of requests for me to talk about Netflix, so we're going to cover Netflix in some pretty good detail here today. I also have 6 other stocks in the streaming services sector we're going to talk about, including Disney, Amazon, and 4 others. We're going to go over the fundamental analysis, the technical analysis, and we're going to talk about which stocks you might want to buy now and which stocks you might want to sell right now. For those of you who are new to this channel, my name is Stock Curry. I'm a former Merrill Lynch and Morgan Stanley investment banker, and I have over 25 years of trading experience. Now, before we get into the 7 stocks to buy now, I first want to talk about the difference between a great company and a great stock price, because they're not the same. Take, for example, a Tesla Model S. A Tesla Model S is a really great electric car with incredible full self-driving. But whether or not a Tesla Model S is a good buy really depends upon the price. If you were to come to me and offer me $10,000 to buy a Tesla Model S, I would take you up on it in a heartbeat. I'd say, here's the cash, let's go. Because $10,000 is a great deal on a Tesla Model S. On the other hand, if you were to come to me and tell me that you were going to sell me a Tesla Model S for $300,000, I would tell you to go kick rocks, because there's a lot of vehicles that are really great cars for way less than $300,000. And so whether or not a Tesla Model S is a good buy really depends upon the price and the value. And the same is true in the stock market. Just because a company is a really great company does not necessarily mean the stock is a really good buy. At the same time, there may be some companies that are kind of mediocre whose stocks are great buys. It all depends upon the price of the stock. So keep that in mind as we're going over the valuation. Just because a company is great and has incredible growth does not necessarily mean the stock is a good buy. It all depends upon the stock price and whether or not it's overvalued or undervalued. Let's get started with Netflix. The first thing you'll notice about the Netflix stock price is that it is absolutely a falling knife. Netflix, ticker NFLX, has pretty much been going straight down, and today fell so much it actually created a pretty large gap. Taking a look at the monthly chart, we can see that Netflix is looking like it's going to go down a lot more from here. During the bear market in 2022, Netflix fell all the way down to the 300-month EMA. And if Netflix were to fall back down to the 300-month EMA again, it would put it somewhere between $35 and $40 per share. So from a purely technical standpoint, Netflix is a falling knife and could fall significantly lower from here, possibly by 50 to 60%. Wall Street analysts have been slashing their price targets on Netflix. Every single analyst has lowered their price target on this stock. Now, I've heard quite a few people say that because Netflix is down 30% from highs, that now makes Netflix a great buy. And a lot of people think that they should be buying Netflix now that it's already down 30%. But we always have to watch out for the falling knife. Falling knife is when a knife is falling and you try to catch it and you just end up getting your hand slit open. And that is what might actually be happening here on Netflix. We look at the stock down 30% and we think, oh, it's a great deal, when in reality, it's still overvalued. Netflix currently has a valuation grade of D-, making the stock extremely expensive even after it's down 30%. Now, the forward PE ratio of 27 really isn't that bad, but it's still a lot higher than a lot of other stocks in the streaming services sector. There are 2 main reasons why Netflix stock has been falling for the past couple of months. The first reason is a slowdown in subscriber growth. And this is to be expected as Netflix has kind of maxed out the number of subscribers that they can have in any given market. Their only hope now for increasing subscriber growth would be to create a product offering that is so strong that people want to come back to Netflix and subscribe, or a move into new markets where they are expanding their market territory and they have new subscribers that they could bring on. Both of those opportunities are fairly limiting, and their subscriber growth is expected to continue to slow down in the years ahead. But we have seen some companies have a slowdown in subscriber growth and still increase profits by increasing the overall profitability and margins of their product offering. So there's definitely still growth opportunities for Netflix, even if subscriber growth does slow down. But that is one of the main reasons why the stock is falling right now. The second reason why the stock is falling is because they're trying to acquire Warner Brothers Discovery. And I have a slight update on that. We're going to get into that in a little bit more detail here. But that uncertainty about whether or not they're going to actually acquire Warner Brothers Discovery is another thing that's pushing the stock down because investors really don't like uncertainty. Now, all of that said, we have to dig deep to try to find a bull case for this stock, because the technicals and the fundamentals and the valuation are all extremely bearish. But I don't just want to leave you with an extremely bearish viewpoint on the stock, because the fact of the matter is that for every single person who's selling, somebody else is buying. And I want to explain why people are buying the stock. I'm going to read some excerpts from the Seeking Alpha article, which lays out the bull case for the stock extremely well. In an article titled "Not at All the Picture the Market Paints," the author says what is becoming increasingly clear is that the market is still hung up on subscriber growth and the possibility that regulators will block the Warner Brothers Discovery acquisition. On the subscriber side, the 23 million acquired subscribers in fiscal year 2025 paled in comparison to the 41 million subscribers added a year before. On the acquisition side, the market is clearly expressing its doubt in an unambiguous way. The 2-quarter margin drops did not help either, and this trifecta has now pushed Netflix down to pre-pandemic levels. But the author thinks the market is getting it wrong, saying Netflix still spends 50% or more of its revenue on content, 55% in Q4 as recorded under the cost of revenues. So what one sees as gross margin decline is actually a step up in content amortization recorded for the quarter or fiscal year. As of Q4, we see continued aggressive spending for growth, with more expected in Q1 2026 and through fiscal year 2026. Record quarterly revenues of over $12 billion and annual revenues of $45 billion have set an even higher bar. And Netflix expects a further 13% increase over fiscal year 2026 to $51.2 billion. The author goes on to say that you cannot ignore the pressure from the pending bid for Warner Brothers Discovery, which now stands at $27.75 per share, revised to an all-cash deal, which is up about 3% from the old bid of $27 per share. The goal here is not a bet on Warner Brothers Discovery being folded into Netflix, but rather the value of Netflix on its own. And there's still significant value that remains locked, regardless of how the acquisition plays out. Put simply, this is a unique opportunity to buy shares in an iconic company that is cheaper than it has ever been in the post-pandemic era. Undeniably, both sides, Netflix and Warner Brothers, are keen on the deal going through. The aggressive $30 per share offer by Paramount Skydance, which we'll talk about later, was rebutted with a conversation of the Netflix Warner Brothers agreement to an all-cash deal earlier this week, thereby also enabling a faster route to shareholder approval at Warner Brothers. But regulatory hurdles remain in the merger, and dissident against such a deal was expressed early on in the proposed deal's life. Elizabeth Warren, a Democrat senator, called it an anti-monopoly nightmare in a statement released soon after the announcement. A Netflix Warner Bros. Would create one massive media giant with control of close of half of the overall streaming market, threatening to force Americans into higher subscription prices and fewer choices over what and how they watch, while putting American workers at risk, she said. Her views were also shared by the co-chair of the House Monopoly Busters Caucus. The reality of Netflix's next leg of growth may not involve a heavy dose of subscriber acquisitions every year. Indeed, that growth can come from the platform becoming a magnet for advertisers, as we're already seeing. In the world of digital advertising, Netflix offers a more conventional way to reach the audience. Another lever is the growth of localized content, which contributes to accelerated penetration in non-English markets. The importance of this lever cannot be overstated because this directly addresses the high penetration in the United States and other developed markets, offering a viable growth path in the future. Yet another growth lever is Netflix Originals, which saw a 9% year-over-year increase in 2025 over 2024, and slated releases for 2026 and originals are clearly driving engagement, which is slightly offset by declines in non-branded viewing hours. Overall, the market as well as the street both appear to be ignoring the underlying fundamentals and looking only at headline subscriber growth and the prospects of the Warner Brothers deal falling through. The author believes these concerns should come to a head after April when Warner Brothers shareholders vote on the deal and the regulatory hoop jumping commences. In summary, some people see Netflix as a buy after a sharp 30% decline from peaks. Netflix's $72 billion all-cash offer for Warner Brothers would push leverage to about 5 times EBITDA, but bridge funding would also be secured and synergies are expected. Access to Warner Brothers studios should enable Netflix to streamline costs, produce more originals in-house, and enhance long-term profitability. The company is also planning to double the scale of its ads business in 2026 versus 2025, and the stock sits at below a 1x PEG ratio, undervaluing the company for its growth potential. So buying Netflix here would require a belief that the Warner Brothers deal will go through, and it would require a belief that Netflix will grow into its current valuation. The stock currently is still too high of a price. However, as it continues to come down, it will get closer and closer to a fair valuation. And so it's just a matter on Netflix of trying to figure out when to buy. Obviously, if it gets down to a $35 or $40 price, it's a clear buy, a very strong buy at that point. But at $87 or even $85, it's still a bit overvalued. And so trying to figure out what is a good price to buy Netflix at is a little bit difficult, which is why we're seeing the price continue to fall. But just keep in mind that the price might bottom out in April once Warner Brothers agrees upon the merger. The reason I covered Netflix is because a lot of people in the comments were asking about it, and some people in the Trading Success U community were asking about it as well. So if you want your stock covered in a future video, leave a comment below. If there's enough people interested in it, I'll include it in a future video. And of course, if you want direct access to me to ask about stock analysis at any time, or if you want to guarantee that you get analysis on your stock, just come join us in the Trading Success U community. I respond to all of the requests there with full analysis. And of course, if you want to learn how to do fundamental analysis or technical analysis on your own, that's available in Trading Success U as well. You can get more information about Trading Success U at tradingsuccessu.com. And on that note, why don't we take a look at Warner Brothers and see how that stock is doing? Warner Brothers stock has been pretty much flat for the past couple of days, and that makes sense given the fact that it's about to be bought out. But the price is currently $28.51, and I want you to keep that in mind as we continue through the rest of this analysis. Warner Brothers Discovery, ticker WBD, has experienced no shortage of drama. The history of the multi-party process involves Netflix, Paramount, Skydance, and others, and they're all trying to buy Warner Brothers Discovery. Now, Warner Brothers Discovery entered into a definitive agreement with Netflix to purchase the studio for $27.75 per share, which was altered to all cash on Tuesday, while Paramount Skydance continues to assert its $30 per share offer as being superior. Warner Brothers Discovery said it will hold a special meeting of shareholders to vote on the deal before April, so sometime in March. Which begs the question of who will actually buy out Warner Brothers. Will it be Netflix at $27.75 per share, or will it be Paramount at $30 per share? Kalshi traders are currently betting that Netflix is going to buy Warner Brothers, with a 67% chance that Netflix will buy them, a 19% chance that Paramount will buy them, and a 15% chance that no one will buy them. So really, Warner Brothers is an arbitrage play. If you believe that Paramount is going to buy Warner Brothers for $30 per share, you should go ahead and buy the stock because you're pretty much guaranteed a $1.50 profit once the deal goes through. However, if you think Netflix is going to buy Warner Brothers at $27.75 per share, then you want to sell Warner Brothers or WBD stock because you're going to lose 75 cents once the deal goes through. Very often, stocks that are about to get bought out will trade slightly below the buyout price due to a little bit of uncertainty about whether or not the deal will go through. And in this particular case, we see that with Warner Brothers. Now, what's unique is that Warner Brothers is actually trading above the price that Netflix offered. And even though Warner Brothers agreed on Netflix, with Paramount coming in and offering $30, they're going to have a fiduciary duty to do what's best for shareholders. And strictly from a monetary perspective, $30 per share is better than $27 per share, which gives a little bit more credence to Paramount buying them out, which is why the stock is trading as if the Paramount deal is going to go through. But Kalshi traders are putting the Netflix deal as the one that's going to go through. So we don't know. And we're not going to know until April when Warner Brothers actually has its vote among shareholders on who they want to buy out the stock. So a little bit of uncertainty here, certainly fairly risky at this point, but we'll see what happens in the future. Now that we've talked about Netflix and Warner Brothers, we might as well talk about Paramount, which is the other one trying to buy Warner Brothers. And taking a look at Paramount stock, this is Paramount Skydance, ticker PSKY. We can see this is another falling knife. And the reason the stock not only goes down, but continues to go down even more is because their earnings are not only negative, but they're actually getting worse. For each of the past 4 years, earnings have gone down and down and down. Paramount is hemorrhaging cash, and normally this is a death sentence for a stock. And that is why the stock has been falling rapidly for the past couple of months. But it's not all doom and gloom, because when we start to look at the valuation, it's actually pretty good. And when you have a stock that's not profitable, it's best to look at the price to sales ratio in order to determine if the stock is a good buy or not. And any company that has a price to sales ratio below 1 is an undervalued stock. In Paramount's case, the price to sales ratio is 0.3, with a future price to sales ratio expected at 0.4. So Paramount is an extremely undervalued stock. And there's reason for that, given the earnings continuing to decline. But if you believe that Paramount is going to turn around and become profitable again in the future, then now is certainly a great time to buy. But if you think that the decline in earnings is going to continue, then there's a good chance that Paramount stock is just going to continue to go down and down and down. And the fact they're losing so much money is the main reason why Paramount has to give a stock offering for Warner Brothers, and Netflix is able to do a cash offering. So that kind of begs the question that if Paramount were to buy Warner Brothers, while it might help some of the profitability, it's actually going to hurt shareholders in the short term because the extremely high cost to actually buy Warner Brothers. And so there's actually a possibility that once Warner Brothers decides that they want Netflix to buy the company, that Paramount stock might actually bottom out and start rallying again, because that fear of a decline due to the Warner Brothers buyout is no longer on the table. So Paramount is a really, really difficult stock to buy from a technical standpoint and a fundamental standpoint, but from a valuation standpoint, it's undervalued. And so if you want to maybe consider buying it, you can. It's just really, really risky. Now let's move on to another streaming powerhouse, and that's Disney, ticker DIS. Now, over the past couple of weeks, Disney stock has been trading pretty much flat. In fact, it's pretty much at the same price it was at a couple of years ago. And although Disney does have a lot of other income streams, such as their parks, the streaming portion of the business has become a larger and larger portion of their overall revenue over the past few years. Unfortunately, Disney's valuation grade is a D, with a PE ratio of 18. Not bad for a tech company, but not great for a streaming service. Their growth rate is a little bit better at a C+, but I really want you to focus on the overall revenue year-over-year growth, which stands at 3.35%. The revenue growth is pretty dismal, and that's why the stock has been trading flat. But there is some opportunity here, and that is because of the earnings growth. The earnings growth, depending upon how you calculate it, could be more than 100% year over year. So overall, Disney is not a stock that I personally want to buy right now. It's overvalued. It's technically not going anywhere. It's just trading flat. About the only real bull case for Disney right now is really their dividend. They still give out about a 1.4% dividend yield. So if you're into dividend stocks, Disney might be a good one. Their dividend has been very, very consistent for decades, and I don't see it going away anytime soon. For dividend investors, DIS might be a good buy. For everybody else, there's just not a lot of potential there. Next up is the third powerhouse in streaming, and that's Amazon with their Prime Video. Just like Disney, Amazon has a lot of other revenue streams beyond streaming, and in fact, streaming is a fairly low portion of their overall revenue. And the stock has been trading pretty much flat for a while now. Like Disney, Amazon's valuation is a dismal D- with a very high PE ratio of 32 compared to a sector average of 16. But where Amazon really shines is in their growth. They're rated an A- on growth, with revenue growth expected to be 11% year over year and earnings growth expected to be around 25 to 30% per year, and by some calculations, more than 50% per year. So overall, Amazon's a little bit overvalued, but its growth is excellent. And if Amazon continues to trade flat, it will grow into its valuation. If Amazon drops down to $161 again, which is the current 52-week low, it would be a great buy at that price. So I would rate Amazon a hold at the current price given the valuation. But if Amazon continues to trade at this price, or especially if Amazon goes down in price, at that point, it would be a buy. And of course, the lower the price goes, the closer it gets to a strong buy. Growth is excellent. The price of the stock is just a little bit too high right now. Now let's cover some smaller players in streaming, starting with Roku, ticker ROKU. And Roku is one of those stocks that absolutely skyrocketed during the pandemic as everybody was watching TV, and then crashed after the pandemic and has since started to go up. Roku's valuation is a dismal F with a forward PE ratio of 313. Guys, that's even higher than Palantir. And believe me, Roku is no Palantir. The reason for Roku's dismal stock price performance is their losses. Roku continues to lose money and has done so for years. But there's a little bit of a silver lining here. And that is because if you look at what's happened to Roku over the past 6 months, it paints a completely different picture. It's like a completely different company and a completely different stock. Over the past 2 quarters, Roku's actually been profitable. And not just profitable, very profitable. Roku is absolutely turning around, making a complete 180 over the past 6 months. Roku has been losing money for years, but in the last 2 quarters, they turned profitable. So I list Roku as a dark knight. This is a stock that could skyrocket once profitability becomes consistent. The stock is already up 100% from lows over the past year, and it could go much higher. Over the past year, the stock has risen from $50 per share to over $100 per share. And Roku is a stock that, although the rate of acceleration in the stock price is slowing down, should continue to go higher over the next few months and years. Of all the stocks we've talked about so far, I actually think Roku is probably the best buy. Certainly not without risk. If those profits turn back into losses again, we could see the stock price absolutely crash once again. But given the fact that Roku has finally become profitable for 2 quarters in a row, if they're able to maintain this and show a full profitability in 2025 and especially into 2026, we could see the stock price absolutely skyrocket and get back up somewhere to $200, maybe even $300 or $400 per share. Now, I'm not saying that's going to happen, but it's possible if they can maintain their profitability. And that's why I think Roku is probably the best bet of all the stocks we've covered so far. The final stock we're going to cover today is Fubo, ticker FUBO. And this is a stock that is also pretty much just straight up fallen, but it has leveled out over the past couple of days. The biggest problem with Fubo is that they've never been profitable. And given the fact they're not profitable, they don't really have a lot of cash in hand, they're just hemorrhaging cash left and right, and really they're kind of on the brink of bankruptcy. To make matters worse, their revenue growth has been declining for each of the past couple of years, from 12% revenue growth in 2023 down to 9% in 2024, and all the way down to 4% revenue growth last year. The stock is down 99% over the past few years, and they're really going to have a lot of trouble staying in business unless they do more share offerings. FUBO has never been profitable, and the revenue growth is declining. The only hope for FUBO is a buyout, which I think would most likely come from Disney, given the fact that Disney just gave them a $145 million loan to pay off their 2026 debt without having to do more share offerings. So if there's any good news for investors, it's that the stock should not continue falling that much in 2026, given the fact they're not going to have to do another share offering this year. On the other hand, if they do get a buyout from Disney, we could see the stock price skyrocket fairly quickly. So FUBO is really a terrible company to buy, but there is some hope for a sudden and unexpected rally in the stock. This might be one you might want to throw a few dollars into and just hope for a buyout from Disney, which is very likely possible given Disney's investment that they just made into the company. So those are my best stocks to buy now in the streaming services sector. If you have a stock that you want mentioned in a future video, leave a comment below. And if enough people are interested in it, we'll go ahead and discuss it in a future video. And of course, if you want your stocks analyzed right away, all Trading Success U members have access to me in the Discord. Just go in there, leave a comment, and I'll get to your question immediately. If you're not already a Trading Success U member, you can get more information about that at tradingsuccessu.com.